Hey guys, and welcome to this community video. This video is a bit special. Either you can watch it like independently and only be talking about how interest rates have an impact on stock prices, or you can also read through the thread that President started back in February 2015 about the current market conditions. I would really recommend you do that. It already has a lot of views. It also have almost, I think, 100 different replies. So there's a lot to read, but a lot of great comments. I've been quite slow. I'd say I really wanted to, give my 2 cents already back in February, and here we are in the beginning of April 2015, and this is my first reply. But I hope that you will find it useful. The book I'll be referring to is actually this one here, there's an article in this book which is written on. It's actually written by Carol Loomis, if you know her. She's a skilled writer and she's a dear friend of Warren Buffett. Warren Buffett gave a very famous speech in California in 1999, and he's talking about the current market conditions back then, which might be somewhat similar to what you're seeing right now. So that is why I'm doing that. If you have a chance to pick up the book, I would strongly recommend that you do that because there are some graph in there and some statistics that are really good. But other than that, there's a few things from that article I would like to show to you. So here we go. So one of the things that I'm missing doing in podcast is the ability to illustrate things. So if you listen to episode 29, where Preston and I were talking about the Fed, we really talking a lot about the interest rate and the impact they have on asset prices, and that's really hard to do again on a podcast because you don't have the chance to show a graph. You might not have the show notes in front of you. So that's really what I'm doing here with this video. As we can see here, we have some dramatically, increases and decreases in the interest rate. And but Warren Buffett did was talking about how interest rates, in particular, but also other factors, are determining the asset prices. And he did that again back in 1999, and he did that by examining two 17-year periods. And again, remember, this is just before the bust of the dot-com bubble, so it's I would say to some extent this is similar to what we are seeing right now here in 2015, and that's really why I've chosen to dig into it. But let's take a look at 1964. So this is our starting point. The Dow Jones was 874, and this is numbers. This is the end of 1964, and I have these numbers from the Warren Buffett book, Tap Dancing to Work. And we can see here the interest rate from the graph is approximately 4%. And what Warren Buffett is doing is that he has a GDP baseline. So I don't know how many $1,000 it is, but let's just see GDP for the US. That would be one. So this would be our starting point. Then he's looking 17 years ahead, and what he sees is this: the Dow has moved nowhere. Wow. So it has moved from 874 to 875. So yes, you might have a few dividend payments and all that, but basically nothing has really happened to the Dow. And what you can see here on the graph, the interest rate is approximately 15%. So okay, we see that the stock market has moved nowhere, and we see interest rate has increased. And what is really interesting here is that the GDP that has almost increased by 4x. So you would see a dramatic increase in productivity. The US is getting wealthier, but because of the high interest rate, or should I say, mainly because of the high interest rate, you would see that asset prices, at least for stocks, that have moved nowhere. So this just shows the importance of interest rate. One of the key ratios we're talking about in terms of determining whether or not the stock market was overvalued is the market cap to GDP. I don't have the number for 1964, so that's why it's not included, but I have the number from 1981. And back then, it was 40%. So if I should just give you a point of reference, between 75 and 90, let's call that like average. So this is really low. This is actually one of the lowest it has ever been. So yes, you probably shouldn't be too surprised because you've seen a huge increase in GDP, but it's not reflected in the Dow. So of course you will have a really low market cap to GDP, and that's another indicator, perhaps, that the market is undervalued. Now let's fast forward 17 years again. Now the Dow Jones is 9,181. Wow, so that is more than 11-fold, right, in 17 years. What is really interesting is that the interest rate has declined. So we almost back to 1964 level. We are around 5%. So again, somewhat low interest rate. Now the GDP is almost 3x, and that is compared to 1981. So you will have an almost 11x, something like that, compared to 64. So you can actually see that to some extent, it does follow the wealth and productivity growth of GDP. But what happened to the stock prices is, a really long-term thing here. And what he's really saying, Warren Buffett, in his speech, is that the interest rate is a major factor for that. He's saying that if you need to make good stock returns, one thing is to look at the interest rate. If that will, decrease, yes, you will make good stock returns. If it will increase, it's going to be really hard. The other factor he's talking about that is the corporate profit compared to GDP. So again, the corporate profit, that's the, it's if you look at it at least historically, you wouldn't expect it to be higher than 6%. And Warren Buffett says that he really doesn't believe that that will happen at all. If anything, it's really not going to change. So, and the third thing is that you will pick the winners. So I think of those three things, especially if you don't know how to pick the winners like Warren Buffett, you really should pay close attention to the interest rate. And what is also interesting is that the market cap to GDP at this point in time in 98, that's 126%. So that is overvalued. And that is approximately where we are right now here in the beginning of April 2015. That is, in this area here. Before the bubble burst, I think we were around 148 or something like that. It was really, really high back in 2000. So, um, it can go higher even though it's overvalued. Again, I wouldn't be surprised if it would go higher today, but I do think that it's really, really overvalued market that we're seeing. And the reason why I'm saying that is not only because I'm looking at the market cap to GDP, that's actually also because I'm looking at the interest rate. Because what happened after 2000, and you can actually see that is that Greenspan lowered the interest rate. Right. So he would have the option to stimulate the economy and stimulate the stock market by lowering the interest rate. It was the same thing that Bernanke did here in the financial crisis in 7/8. Is that slowly as the stock market decreased, and then there was this huge bust on the stock market. Then he would really lower the interest rate. I think it was from something like 5.25 to just above 1%. Now it's approximately zero. We don't have that option today. So if something goes wrong, we cannot lower the interest rate, and I think that will have a huge impact. Now, what will happen is really hard to predict. Um, Basically, we haven't tried this before. Even Charlie Munger and Warren Buffett, who is a bit older than I am, they don't know what's happening. And Charlie Munger is actually just recently quoted for saying that he doesn't know what's happening because he never seen this before. So yeah, again, I have no clue what's happening, but I think that if something goes wrong because the interest rate is as low as it is, things can go very wrong. So basically, guys, that was my 2 cents about the current market conditions. I hope this was useful. And another thing I just want to say is that if you have any kind of feedback, you are always welcome to tweet to me, or you can send it to me directly at asktheinvestors.com. Now, again, this video is also for the community of Buffett's books, and really, thank you so much for all the things I have learned from you. Just reading your post and communicating you, that has really been amazing. Things has changed a bit. I know it sounds like a bad excuse, but a year ago I had a chance to really look through all of the posts. I kind of don't have that time now, and also the traffic is a lot higher on the forum than it used to be. So if you have anything in particular, feel free to send me an email directly at asktheinvestors.com. You also have the chance to record a question in there. So if you want to do that, feel free to do that as well. Other than that, guys, that was it for today. I would usually return with a video at 1 or 2, sometimes 3 video a week. So I'll be back in a week with the new videos. Take care.